Hello everybody and welcome to this video on Cloudflare. So today I want to talk about Cloudflare, which is a infrastructure as a service stock, and Cloudflare is one of these stocks that's part of the revolution of the cloud. Um, which really was started with AWS, Amazon Web Services, who took compute power that companies would typically have within their premises and put it into the cloud and started renting it based on the usage. And this is something that Cloudflare is doing for the internet infrastructure. The internet infrastructures, i.e., all of the sets of routers, traffic managers, DNS, all of this set of network equipment companies used to own in the past. They used to own, and they used to oversize it, i.e., you would manage your equipment for the biggest day of the year. Like, let's say the 3 weeks before Christmas is when you sell most of your stuff, and so you would oversize your equipment and always underuse. But just because of those few weeks where usage is going to be insane, you have to have very, very expensive equipment. Well, Cloudflare solves that by recreating a network and recreating this equipment in the cloud. So instead of having individual companies buying all this equipment, Cloudflare buys it for everybody and then rents it in the form of the cloud. And Cloudflare has a full cloud offering, which makes operating the internet and operating a website much simpler and also makes it scalable on demand for its customers. So it's an on demand infrastructure and you pay by usage, right? You wouldn't pay based on all the equipment. So this is the general idea of the business and what the business model is. Um, and the outlook for the business is very, very strong in the future. Why? Because this rides on two megatrends. The first megatrend is everything going into the cloud and everything being sold as a service, infrastructure as a service, software as a service. This is a megatrend for companies because companies can become more agile when their cost structure is as a service, such as if you have a huge spike in demand, all of a sudden you can meet that spike in demand. This is how we can explain something like Zoom video calls scaling to a 20x size within a matter of 1 week or 2 weeks during 2020, the events of the 2020. We scaled 20x in 2 weeks. This is impossible for a classical company, for a traditional company, but it's possible for any company that has a software um, as a service, infrastructure as a service, software as a service. If you use it as a service setting, this is possible for you to do that. And I would argue the other part of a mega trend is that more and more people are connected to the internet. I mean, most of the planet is connected, but there's still people in emerging nations that are getting an internet connection. But perhaps more importantly, the amount of time that we spend on the internet is increasing tremendously with things like the metaverse, all of the forms of entertainment that are going on our phones, and the amount of devices connected to the internet is also growing exponentially. So these companies' revenue may not only grow, but it may have some exponential growth within a few years as the usage of internet keeps growing and growing and growing. Like I said, this is a mega trend. So you really want to be in a company that has such a big tailwind in its market. So I'm doing a new format on the slides, and let me walk you through the financials of the company and, in a nutshell, what I think is important for an investment and why I think Cloudflare right now is a great investment and why I'm buying Cloudflare. Not investment advice, of course. So the most important metric for any investment, in my opinion, is growth. Eventually, the very long-term growth rate of revenue will eventually be the return of the investment. Like, that is so essential. If you don't grow the top line, you're not going to grow your bottom line and you're not going to grow as a company. The top line is a wonderful thing to look at when you look at a company because nobody can cheat the top line. You can't really cheat the top line. And it's the purest measurement of customer demand and how much of your product you're selling. And so when I see a company like Cloudflare, I am very, very, very happy because I see that they're growing at about 50% a year, and actually they're recently accelerating. So their growth is recently accelerating at 51 and 54% respectively. So I think over the long term, they may keep growing at 50% a year for 5 to 10 years, right? Some years more than 50, other years less than 50, but 50% a year growth, that's huge. That's tremendous. Um, are there any revenue headwinds? So this is the thing that I look at because, of course, when a market is very attractive, you might have competition. So the first headwind that I look at is competition. And when I look at the competition of Cloudflare, I think about the legacy players, companies like Cisco, for example, or Fortinet. These companies are very large behemoth companies with multiple layers of management, perhaps 10 layers of management. They're not agile. They don't move very fast. They're incumbents, right? So even though they're tech incumbents from 20 years ago. The way tech works today is much faster. So I don't believe this competition is much of a threat in that a lot of people in sales, people in software in these companies are siloed and they don't necessarily want to change the way they do business. So I really don't think the history of tech is on the side of the incumbent. I think the history of tech is typically on the side of new players. Now, there is another type of competition for Cloudflare, which are the new software. And the main other type of as a service business that I see as a competitor for Cloudflare is Fastly. But when I do a little research on Fastly, I see that they're not doing nearly as well as Cloudflare. They're a much smaller company. Their sales are really not growing much, about 10% a year, and they have much financial problems. So I don't see Fastly as a competitor for Cloudflare. Cloudflare is typically is the leader in this, and they will most likely end up winning the whole market. So that's what I see for Cloudflare on this. Competition is very small, and I don't see competition as being a big threat. When I look at concentration, you don't want just one customer. There is no concentration risk for Cloudflare. Dollar retention rate. That is how much more their customers buy each year, year after year. How much more do they buy? And what they see is that they have a 126% retention rate, which is really high, which means that customers who spend 100 at year one of being a customer will spend 126 at year two. And then times 1.26 times 1.26 times 1.26. So we can really see how these growth numbers are amazing, partially because of this retention rate, which is customers keep coming back for more. They keep coming back for more options. And then, is this sensible to macro, right? Is there a lot of sensitivity of this company to the growth of interest rates? And then again, I don't think there is, because this business is a cost-saving business for customers, right? Their customers save costs because now they can get rid of expensive infrastructure and they can get access to an agile infrastructure. So all of these as a service cloud stocks save costs for the customers. So I think this is pretty much recession resistant. I also think that the internet will keep growing regardless of what happens in the macro world. So I really, really like that. Then the runway. What about the runway? The growth runway for Cloudflare is tremendous, right? They have a huge total addressable market left that not only they haven't even begun to address, but keeps growing. And then they have some optionality in what they do. They constantly roll out new products. I was leafing through their investor presentation, and they've rolled out at least 3 waves of products between the last 3 years. So they'll keep releasing new products that will not only increase the scale of what they sell, but as well as the scope of what they sell. And the internet, the traffic, the IoT devices, they're never going away. So there's a lot of good things going on for growth. But when you look at a growth company, you want to be very careful because there's things that are problematic when companies grow. For example, you don't want a company to grow by acquisition. Growth by acquisition is typically bad because CEOs tend to overpay. There's lots of research that shows that acquisitions, most of the time, their benefits are overstated and people will overpay. So you really want organic growth. At least that's what I prefer. And Cloudflare has done a few acquisitions at around $100 million, but really, really not many. So they don't grow by acquisition. They grow their top line mostly organically, But there is a little bit of a downside here, which is the marketing expense. So I put it as a medium issue here. It's higher than I'd like. They spend a lot on marketing. It's typical for this type of business, for SaaS type business, to spend as much on marketing as they do. But close to half of their revenue goes towards financing marketing. So they have quite a bit of a high spend on marketing. One important thing to talk about marketing expense is, it's a big question in tech right now, is marketing an expense or is it an investment? So if you're spending a bunch of money to acquire one customer, the idea is that it could be an investment if this customer is then enrolled, stays with you for 10 years, and keeps spending and spending and spending. So that's also why for this type of recurring buy, right, a recurring business like that, we're okay with a bit larger marketing expenses to acquire customers. But keep in mind that this is something that you always want to look at, because the marketing expense typically really eats into your gross, into your profits down the bottom line. So you want to make sure you don't have too high marketing. Their marketing is medium. It's a bit higher than I'd like to see it, but it's okay given the type of business. So let me move on. Okay, any newer business like Cloudflare that was recently introduced in the market, one thing you want to make sure is that they don't go bankrupt. To me, this is perhaps the second most important thing. I don't want the company to go bankrupt because they're still executing. They're at the very beginning of their growth journey, and so you don't want them to go bankrupt right now, right? Because otherwise they're not going to execute. And so what happens is, like with the raise of interest rates right now, it's very likely that a lot of companies are going to go bankrupt because they can't raise any more cash because valuations are depressed. And well, if your cash burn if your cash burn is so high and you don't have much cash or short-term investments in your balance sheet, uh, you are not you are not going to survive for a long time. And so when I see Cloudflare, okay, so they have a positive cash flow. So they don't have any issues burning cash. They don't have a cash burn. They're actually bringing in cash flow, right? Which earnings don't show. Earnings don't show that. Earnings are all about paying taxes. They don't show cash flow. We care about cash flow, and we care about this company not going bankrupt until it achieves scale. And Cloudflare really has that. So I love that they're cash flow positive, and bankruptcy to me is not an issue anytime soon. Now let us look at profitability metrics. Gross margin is an astounding 77%. That is very high by all standards of business. And the price to gross margin, which is one of my preferred metrics, is a 28. So it's very reasonable for a company that's growing at 50% a year. Now, one thing I like to do when I look at my margins is going back into the 10K and the 10Qs and looking at how much they spend on marketing. And you can see that once you remove marketing expenses for this company, actually the post-marketing margin is 34%. It's 34%. Now, I'm not talking about an operating margin, because an operating margin would have administration and R&D. But in my mind, administration and R&D are much closer to an investment for the long run than marketing is. When you spend money on marketing, you can't really recoup that cost. So that's why oftentimes when I think about marketing that you spend to drive revenues, to me, I look at more as a cost of sale than I do look at as a cost of administration. So I think marketing, it's important to take into account marketing in the revenue growth companies, in high revenue growth companies, because companies that grow really high, but have a tremendous cost of marketing, cost of acquisition, well, it's less of an attractive business. And for Cloudflare, like I said, it's a medium flag. They could spend much more on marketing, and it could be terrible, but they could also spend less. And so marketing is okay. Um, Operating and net margin, they're less relevant to me. I don't spend much time looking at operating and net margin because I believe that these will eventually grow as the firm scales. Because, of course, for most growth stocks, they're going to be negative. And so many investors discount these growth stocks and just put them aside because they see, oh, they have a negative operating margin and negative net margin. To me, that's way less important. What I care more about is the cash flow. Do you have free cash flow? or not? Do you have a cash burn? If you have a cash burn, that means you're going to go bankrupt, and I'm worried. I care more about that than operating in net margin. So they're not really meaningful for a company that's at the early stage of its growth stage. Now let me move on to the debt of Cloudflare. If a debt is medium, I like to see below 3. Debt. I think a lot of investors wrongly hate debt. Like, you need a little debt because you want to have a little bit of operating leverage. You don't want to have no leverage at all. So you need a little debt, right? Monetary printing impacts everybody, and if you take debt, that's a way for all companies to short the US dollar. So you want a little debt. You just don't want them to go too crazy. And I think Cloudflare is a little high, but again, it's medium. It's not a red flag here. And I do not think, in the case of Cloudflare, that this amount of debt makes them fragile, right? I don't think they make them fragile. I think they have a pretty recession-resistant business, and thus it's okay for them to have a little more debt than average. All right, another important thing to look at when you do comprehensive analysis of a growth stock and ask yourself whether they're going to beat the denominator is look at whether you're actually getting diluted or not. Now, Cloudflare 2 years ago, I would have never wanted to invest. They did something like a 3x issuance of new shares, which is terrible. But right now, if you look, they grow their shares about 5% a year, so they dilute you as the stockholder about 5% a year. I think it's okay. They have to do stock-based compensation to attract talent, and that's oftentimes a great way to actually hire someone without raising your risk of bankruptcy, right? Without actually impacting your cash flow when you do stock-based compensation. So I'm okay seeing stock-based compensation because that reduces the odds that the company is going to go bankrupt. Like, we understand if a company gives out stock options, it's a much better thing for the company than actually giving out cash, because cash can actually giving away your cash can make you very fragile. So I don't think this is a problem anymore. This used to be a problem, but now it's been going pretty steadily up, but really not that much up. So I really like seeing that. Insider ownership. The CEO still owns 13%. I love seeing that. That's a sign that most of the CEO's wealth is in that company, and that company is probably most likely well managed. There's a lot of research that shows that founder-led companies do much better, right? Amazon was founder-led. Apple was founder-led. You can go on. Microsoft was founder-led. Founder-led companies just do better. And insider ownership is fair. So yes, and yes, this is very good. The last one, and this is my only red flag for this company, is the revenue per employee. Only 264,000 of revenue per 64,000 in revenue per employee. This is very, very low revenue for a tech firm. Like, I would expect to see this revenue per employee much higher. And so I see that they ramped up their hiring in the past 2 quarters, and I mean, there's no two ways around it. I really, really don't like that. I don't know if they're going to have to do layoffs or anything like that in the future, but the revenue per employee is not good. Now, the company is growing really, really fast, which means that they can grow into their number of employees. But now it's time to not hire as much. Now it's time to actually make the employees more productive. I do think that this number is low, which is a bad thing. This is definitely one thing to watch going forward. Are they still hiring so many more employees much faster when they're growing revenue? But this is a bit of a red flag. Let me move on. So what about now? Is Cloudflare a good investment right now? Well, actually, if you look from late 2020 to today, late 2022, the stock is essentially flat. Right? So it did a 6x, and it's lost its 6x, and it's back to the level that it was back in late 2020. So I would argue it's one of the cheapest valuation that we've had on this company. So I think it's a good deal from that standpoint. Same if you look at price to sales, one of the lowest valuations that we've had on this company as well. Now, what I like to do when I look at this type of and to understand, there's a little bit, there's not that many companies that are as appealing as this. 50% growth rate. That's an amazing business. That's an amazing company. That is a company that, if you make a mistake, if you overpay a little bit for a company that does 50% growth, that's a very forgiving mistake because eventually you are guaranteed that the company will grow into its valuation. If you were to overpay for a company that has, say 5% growth, then it's too late because you've overpaid for a company that will never grow into its valuation. So I just want to say valuation is a little more forgiving for companies that grow at 50% a year. But these companies are very special companies, and these opportunities are really a blessing today. So I wanted to compare Cloudflare to other companies that I really like right now. And you can see Cloudflare is pretty much in the ballpark of companies such as CrowdStrike and Enphase and even Tesla. All of these companies, I would argue, CrowdFlare, Enphase, Tesla, Net, I would expect similar returns for these companies. So it makes sense to diversify into these companies. I would argue here when I look at Datadog, which will be the topic of the next video, Datadog is actually a little bit better than all these companies right now, with a very reasonable price to post marketing margin, which is my metric that I use to take out marketing expense, which I think marketing expense is mostly a lost expense. So I want to take it out. And to me, if I look at this valuation, it's got one of the lower valuations along with Tesla, right? So if I were to look at my chart here, Datadog and Tesla would be the better priced opportunities out here. And they all have similar growth. Like notice how they all have growth within the 50%. So I hope to make a video on each of these companies upcoming. So stay tuned and make sure to subscribe to my channel because I'll be doing these videos. But very attractive metrics for Cloudflare, which is why I'm buying the stock and I'm planning on buying more of this stock. And lastly, let me finish with kind of a trademark of this channel, which is, well, we got to look at the US dollar, right? So the US dollar in 2022, $1 equals $1. 2027, per my estimates of 15% expected dilution going forward, 2027, $1 equals 50 cents. 2042, $1 equals 25 cents. So we need to take that into valuation when we ask ourselves the question, could we see this company actually be a 10x or a 100x? So a 10x, it's a $17 billion company. It could become a $170 billion company. This is not a crazy thing to think about. Cisco is bigger than 170 billion, and that's the type of company that Cloudflare is going after. In fact, I would argue that Cloudflare is going after Cisco and many other companies in the sector. So it's not that far-fetched to see this valuation. 100x is a little bit harder to see, but I would argue anywhere, and that's a wide range, but anywhere between 10 and 100x, I think is realistic within a 10-year period for Cloudflare. And I'll just end with this thought. Let's assume 170 billion. So today, that's a huge company, right? But in 2032, if we take into account the dilution of the dollar in 2032, that would only be the equivalent of a $42 billion company today. Only a $42 billion company today would be 170 billion in 2032. So the denominator works our way. And since this company is beating the hurdle rate, beating the speed at which we print US dollars, you can expect to win on both sides. So this would create, in my opinion, very high nominal returns. And so that's why I'm happy to be bullish on this stock, as I am on all these other companies on which I will be making videos shortly. So thank you so much for watching. None of this is investment advice and will never be investment advice. Thank you so much for watching, and I look forward to seeing you in the next video. Don't forget to like and subscribe, and tell me what you think about the new format. Like and subscribe. Thank you so much. Have a great day. Thanks.